Hello, Tim Tucker here from United Way Central Ohio Tax Time Training with another training video. In this video, we're going to discuss the 1099-R, including taxable amount and several other issues which I know folks have found confusing in the past. In this video, we're going to cover the following items. When is the simplified method needed to calculate the taxable amount? What's the best practice for performing the simplified method calculation? When is the simplified method not needed to calculate the taxable amount, which is going to be most of the time for our tax preparers? What about that mysterious box 5 on the 1099-R? What does it mean? What do we do with it? And finally, what do we enter in TaxSlayer for the state distribution and local distribution when these boxes are blank on the 1099-R, which they are so often? When is the simplified method needed to calculate the taxable amount? Well, let's step back and ask ourselves the question, why isn't the taxable amount just always equal to the same as the gross distribution? That's because in some cases, the taxpayer contributed a basis of post-tax dollars into the pension plan. Since these dollars have already been taxed, the taxable amount of their distribution is going to be smaller than the gross distribution. The simplified method is a calculation which allows the taxpayer to recover that post-tax basis over a number of years. How do we know that we need to use the simplified method to calculate the taxable amount? If the taxable amount in box 2A is blank and the box taxable amount not determined is checked, and there's a entry in the total employee contributions in box 9B, then you're going to need the simplified method to calculate the taxable amount. Let's take a look at this example. So we see that the box 2A is blank. So for whatever reason, the annuity provider decided they can't or will not calculate the taxable amount for you. And they've also checked the box 2B to indicate that they have not determined the taxable amount. And box 9B shows what is the taxpayer's post-tax cost basis into this pension. So in this case, the taxpayer had contributed $15,000 in post-tax dollars, and that is going to be recovered over the lifetime of the pension spread out over a number of years. And one last point, the simplified method is not applicable for pensions or annuities where the payout date started prior to July of 1986, but I doubt that's going to be an issue for any of our clients. What's the best practice for performing the simplified method calculation? We're going to need some information to get started. From the taxpayer, we're going to need the month and year when the annuity started. And if we're lucky, they will bring in their return from last year, which will have a simplified method worksheet, which gives us this information. We'll need to know whether this is a single person annuity, i.e. just the taxpayer, or if it covers the taxpayer and spouse. We'll need from the intake form the birth date of the taxpayer and the spouse if it's a joint annuity. And from the 1099-R, we will need the gross distribution and the total employee contribution. Once we have all the needed information, we will proceed as follows. Step 1, we will use the annuity pension exclusion calculator from the Colorado Resource Toolbox. This tool makes it very simple to perform the calculation, and once we have run the tool, we will know the taxable amount. It's a good idea to print a copy of the results from this tool to include with the return for the taxpayer. For step 2, we will use the values from step 1 as entries into the TaxSlayer tool. The TaxSlayer tool, in my opinion, is an inadequate tool because it requires us to manually calculate certain values that are automatically calculated using the tool that we used in step 1. So really the only reason that we're running the TaxSlayer tool is so that we will have a record as part of the return in this worksheet that will print out along with the return. And this will become more apparent as we go to the next step and see how all this works. We're going to use the 1099-R that we showed earlier for our example calculation. So the annuity start date is 11/1/2020, and this is something that we're going to have to either ask the taxpayer or get from information that the taxpayer brought in from last year's return. Type of annuity is a joint survivor. We get that from the taxpayer. The birth dates we get from the intake form. The gross distribution and the total employee contribution are shown on the 1099-R. So for step one, let's go to the Colorado Resource Toolbox tool and get the annuity calculator. To find that tool, if you're a member of our Slack community, you will go to the general channel and go to use websites, which will pull up a document, and then you can go to the Simplified Method calculator. If you are not a member of our Slack community, you can look at the link that I will put in the description below this video. So here's our calculator. And first thing we want to do is make sure we're on the proper year, and it will default to the current tax year. And so in my case, it's 2023. We know that our annuity start date was 11/1/2020. The taxpayer birth date was 4/30/63. The spouse's birth date was 10/7/54. And you can see at this point, the tool has done a few nice things. It's calculated the age of the taxpayer and the spouse and the combined age at the annuity start date. This is something that the TaxSlayer tool does not do. And it actually can be a little bit tricky to come up with these ages without the help of the computer. So we know that the gross distribution from the 1099-R was $20,000. We know that the total contributions were $15,000. So now we have all the information needed. We can click this button to calculate the result. Let's look a little bit closer at the output from this tool. First of all, the answer to the question of the taxable amount is shown right here. The taxable amount for box 2A is $19,419. The tool also tells us how much was previously recovered, which is $1,259. That means since the pension was started, that's how much of the original employee contribution of the $15,000 has been recovered tax without being taxed. There's also a tax exclusion table which shows how much has been excluded each year, and it also shows how long you will actually how long it will take to recover all of the initial employee contribution. So in this case, in 2046, that year, you will get the final amount of recovery of the total employee contribution. One thing to point out is some terminology. The term amount previously recovered actually refers to the amount that could have been recovered had everything been done correctly. And what I mean by that is, let's say in 2022, whoever prepared the taxes did not use the simplified method and set the taxable amount to the entire gross distribution. So they actually got taxed on more than they should have. When you do the 2023 taxes, you can't say, well, I want to recover both 2022 and 2023 because I didn't actually recover that in 2022. It doesn't work that way. Each year stands alone. So in 2023, you can only recover the amount that you would be due had you recovered everything properly in the past years. If you made a mistake in 2022, you will have to go back and amend that year to recover that amount. One other thing to point out about this tool is there's a button up here called Video Tour, which will bring up a nice video which explains the many features of this tool. A number of them I have not covered. Step 2 is to use the TaxSlayer Simplified Method worksheet so that we have a record in our return of the taxable amount. So I've gone ahead and filled in the 1099-R for this taxpayer, and as you can see, as soon as you fill in the gross distribution, it's going to fill in the taxable amount to be identical. Don't worry about that. That will get overridden once we do the simplified method. So in order to do the simplified method, I'm going to click here. And then on the simplified method worksheet, I will do begin. And then there's some details about when you can use the simplified method. Hit continue. And now I will enter the data. The plan cost at the annuity start date, that's box 9B, that's $15,000. The starting date of the annuity was 11/1/2020. We know it's a joint survivor annuity. The age of the recipients at start date, we knew that from the tool was 123. And that's one of the things that TaxSlayer does not do for you automatically. So that's one reason why we should use the Colorado Resource Toolbox tool to get that number. The number of months paid in 2023, we received the pension all 12 months. The amount previously recovered, again, we go back to our annuity pension tool and we see that was $12.59. And then we hit continue. And we see that it calculated 19419, which is the same as we got with the other tool, which is good. So this is kind of a sanity check that the tools agree. So I'll hit continue, and when I hit continue here, I'll answer no to this disaster withdrawal, and then I'm done. When I generate the PDF of the return, we can see that there is a simplified method worksheet included in the output, and if I scroll down, I will see that worksheet here for my tax client. So this will be a nice record, assuming that they bring in the return next year when they come in for tax preparation. So far, we've talked about the simplified method and when to use it. But in most cases, you're not going to need the simplified method. I think the best way to illustrate that is to look at some examples. And in all these examples, the taxable amount is either given to you or it's implied. So let's start off with a very simple example. Box 9B is empty. Box 2A, the taxable amount is specified. And the box 2B, taxable amount not determined, is not checked. So nothing really to do here, just key it like you see it, enter it exactly as shown here. In this second example, it is a slight variation of the 1099-R shown in the first example. The only difference is box 2B, taxable amount not determined, has been checked. For some unknown reason, sometimes we see 1099-Rs like this where the taxable amount is shown, yet the box taxable amount not determined is checked. In this case, the taxable amount indeed is the same as the gross distribution. There is no post-tax basis shown in box 9B. So the results are going to be the same as example one. Key it exactly as you see it and include the check mark in box 2B. This third example is again a slight variation on example one, only in this case, box 2A is empty. The pension provider did not provide a taxable amount. However, box 2B has not been checked, and there is no post-tax basis shown in box 9B. So the taxable amount is going to be equal to the gross distribution, and in fact, TaxSlayer will automatically fill in box 2A with the correct amount, which will be $20,000. So again, just key it like you see it, and TaxSlayer will take care of the rest. In this example, we'll show a couple of 1099-Rs, which you're likely to see in practice as an Ohio preparer. One is from OPERS, the Ohio Public Employment Retirement System, and one is from STRS, the State Teachers Retirement Pension Fund. Now, in both cases, box 9B is empty. Box 2B, the taxable amount not determined, is not checked. Box 2A does have a taxable amount in it. Now, if you'll notice, box 5 has the amount that can be recovered tax-free this year. And may also notice that box 1 minus box 5 equals box 2. This is typical for most 1099 hours, and we're going to talk more about box 5 later on in this video. So essentially, OPERS and STRS has run the simplified method already and come up with the calculation of what can be recovered tax-free this year and put it into box 5. So again, we're gonna key it like you see it. TaxSlayer will automatically fill in box 2A with whatever you put in box 1, but then you'll replace that value with the value shown in box 2A on the 1099-R. One more point I'll make for when you're manually entering a taxable amount which is less than the gross distribution. In this case, I've entered the amounts from the OPERS 1099-R that I just showed, where the gross distribution is 43,444 and the taxable amount is less than that, 42,682. When you've entered it and you hit continue, you will always get this pop-up message about concerns. And this is really just a sanity check from TaxSlayer. It's saying that the taxable amount is less than the gross distribution. Did you really mean to do that? And it's typically the answer is yes. You'll just continue. Here's an example with a slight twist. In this case, box 9B is empty. Box 2A, the taxable amount, is empty. But box 2B, taxable amount not determined, is checked. So somehow we need to determine the taxable amount. Now, in this case, box 5 contains the amount that could be recovered tax-free this year. The pension provider has basically run the simplified method and calculated that for us. So what we will do is we will calculate the taxable amount by taking the gross distribution, $20,000, subtracting box 5, and that will leave us a taxable amount of $19,350, which we will enter into TaxSlayer for the taxable amount. In this example, box 9B is empty. Box 2A is not empty. It contains the value 0. Box 2B, the taxable amount not determined, is not checked. So in this case, the taxable amount is actually 0. That's what the pension provider has told us. So key it like you see it. TaxSlayer will automatically fill in box 2A with the amount from box 1, and then you'll replace that value with 0, the value shown in 2A. So what about that mysterious box 5 on the 1099-R? The IRS defines it as employees' contributions, designated Roth account contributions, or insurance premiums, and they add later on it's just life insurance, that the employee may recover tax-free this year. That's key. The employee may recover tax-free this year. So box 5 should always represent box 1 minus box 2A, just like we saw on the OPERS and STRS 1099-Rs shown earlier. In other words, it represents the amount that can be recovered tax-free this year. But there is at least one exception, hopefully the only exception I know of, and that is the CSA 1099-R, which you may see as you're doing tax preparations. Is from the Office of Personnel Management, which basically pays federal retiree pensions. They disregard this definition. They use box 5 to report health insurance premiums, which do not reduce the taxable amount. And you can see that's the case in this example below, because the amount in box 5 does not equal the difference between box 1 and box 2A. So amounts in box 5 on CSA 1099-Rs can be used for Schedule A medical deductions, itemizing, as well as the Ohio unreimbursed medical expenses, which we will be covering in another video. If you were entering this 1099-R in TaxSlayer, you would basically key it like you see it, enter all the boxes as shown. I've received a number of questions about what to enter into TaxSlayer for the state and local distributions when these entries are blank on the 1099-R. Well, in general, the rule is key it like you see it. If there's an entry for the state distribution or the local distribution, put them in the TaxSlayer as per the 1099-R. If they are missing or blank, then leave them blank on TaxSlayer. You may wonder how we can do that, leave the state distribution blank. Are we going to be missing some taxes for Ohio? Well, the answer is no, because if you think about it, the Ohio tax base starts off using the federal AGI. The federal AGI is based off what gets entered in box 2A on the 1099-R. So this really doesn't have any effect on the tax calculations. The important thing to note, however, is if there's any state income tax withholding, box 14, make sure that that is entered into TaxSlayer along with the state, which would be part of box 15, and the state ID, which is also part of box 15. The tax withholding is definitely needed in the calculation for the overall Ohio tax. Thanks for watching. I hope this was helpful. If you have questions or comments, you can leave me a comment on my YouTube channel, or ping me on Slack, or send me email at timmythetaxman@gmail.com. I will include links in the description for this video that point to our FAQs on Ohio and other tax topics.